Now let us talk about some more amendments which are applicable for November 2018 examination. The first one is the applicability of e-way bill. Friends, to clarify over here, there is no amendment in the provisions of e-way bill. The only amendment that we are going to discuss is by when e-way bill provisions will be applicable. In our module, we had discussed about the e-way bill provision, but the applicability of e-way bill was not defined. However, government came out with a notification which made e-way bill mandatory for all interstate movement of goods with effect from 1st April 2018. Friends, we all know that there can be two kinds of movement of goods. One, either it can be an interstate movement of goods or it can be an intrastate movement of goods. When we say interstate movement of goods means when the goods are getting transferred between two states. That means if I'm sending goods from say West Bengal to Maharashtra, this will be regarded as an interstate movement of goods. However, the other kind of movement of goods is the intrastate movement of goods. That means when I am moving any goods within the same state, that means suppose I am transferring certain goods from say Kolkata to Howrah. In that case, since both Kolkata and Howrah are part of the same state West Bengal, it will be regarded as intrastate movement of goods. Friends, the government declared 1st April 2018 as an effective date for the applicability of e-way bill for all interstate movement of goods. That means if you are moving any goods between two states, in that case it is mandatory to have your e-way bill. Now what about intrastate movement of goods? For intrastate movement of goods, the respective state governments have notified the dates for which the implementation is applicable. That means each state has issued their own notification regarding by when the e-way bill provisions will be applicable. The provisions of e-way bill in the intrastate law is more or less same. That means if you are suppose moving certain goods from one state to another, in that case you are required to issue e-way bill under the provisions of CGST law. Okay. However, if you are moving any goods intrastate, in that case you will have to issue e-way bill under the provision of SGST law. And therefore, each state government had issued their own notification to specify by when the e-way bill provisions will be applicable in their own state. Whether the provision of e-way bill law for intrastate movement of goods is same as that of interstate movement of goods. Friends, what we have discussed in our module is the e-way bill provisions which is applicable for all interstate movement of goods, because that's what is part of your examination. In your examination only CGST rules are covered, and therefore we have discussed the interstate movement of goods. That means e-way bill provisions as per the interstate movement of goods. Now, for all intrastate movement of goods, the basic structure of the law or the provisions is same. That means whatever we have discussed for e-way bill provisions, the same provisions, more or less the same provisions is applicable for all intrastate movement of goods as well. Friends, moving on to the next amendment. We have discussed when we were discussing about the provisions of job worker. In that case, we have discussed that whenever there is any goods which are sent to the job worker, it shall be under the cover of a challan which shall be issued by the principal. That means if a principal is sending any goods to the job worker, in that case the principal is required to issue the challan. That means no goods shall be transferred without a cover of a challan. And this was covered under Rule 45 Sub Rule 1. So Rule 45 Sub Rule 1 used to read as the goods shall be sent to the job worker under the cover of a challan issued by the principal. Now the problem which lies is when we were discussing about the provision of job worker, we have discussed that a principal can send the goods to a job worker and that job worker can again send the goods either back to the principal or he can send the goods to another job worker. And not only that, he can also sell the goods on behalf of the principal. Now, Rule 45 Sub Rule 1 only covers one situation. That means when the goods are sent to the job worker, it shall be under the cover of a challan. Now, the question which comes is when the first job worker is sending the goods to another job worker, in that case, what will happen? Who will issue the challan, or can the goods be sent without the cover of a challan? So there was a drafting error in this particular provision. In order to correct that, an amendment was introduced. And the amendment has introduced two aspects. What are they? For goods sent by one job worker to another, challan can be issued by the principal or the job worker sending the goods. We will discuss this with the help of a graphical representation. But just to explain this provision, suppose principal has supplied certain goods to job worker 1 and now the job worker 1 wants to send the goods to job worker 2. Obviously, he will send that only because the principal would have asked him to do that. In that case, when the goods are being sent by job worker 1 to job worker 2, in that case, challan can be issued either by the principal or the challan can be issued by the job worker 1. The second aspect which was introduced was challan issued by the job worker can be endorsed by the job worker indicating quantity and the description of the goods. So when the job worker is issuing the challan, in that case he can endorse that by way of specifying the quantity and the description of the goods. Let us try to understand this provision with the help of a graphical representation. So suppose there is a principal who is supplying certain goods to the job worker and the job worker is supplying the goods again to another job worker. Now there can be multiple scenarios. What are they? When the principal has supplied the goods to first job worker, the first job worker is then supplying the goods to the second job worker. Now, the second situation can be the job worker is receiving certain goods from another job worker. In that case, what can happen? The challan to be issued by the principal. If the principal is supplying the goods to the job worker or the job worker is receiving the goods directly, in that case, challan has to be issued by the principal. This was already covered. But the amendment is when the first job worker is supplying the goods to another job worker, in that case, challan can be issued by the principal or by another job worker. Okay. Moving on to the next amendment, which deals with the anti-profiteering provision that we have discussed. This is a very small amendment, not very significant from an examination point of view, but it is a good to know provision. As per Rule 125 of the CGST rule, there was a requirement that additional director or general of safeguard shall act as the secretary of National Anti-Profiteering Authority. Now this has been amendment. Rule 125 has been amended. Now instead of additional director general of safeguard, the provision which has been introduced states that officer not below the rank of additional commissioner working in Directorate General of Safeguard shall act as a secretary to National Anti-Profiteering Authority. We have discussed about this provision that there is a requirement to set up a National Anti-Profiteering Authority. And Rule 125 used to say that Additional Director General of Safeguard shall act as the Secretary of National Anti-Profiteering Authority, which has now been amended, and instead of Additional Director General of Safeguard, any officer not below the rank of Additional Commissioner working in Directorate General of Safeguards can act as a Secretary of National Profiteering Authority. Moving on to the next amendment. This is with regard to the clarification which has been issued by the government with regard to cost petroleum. Now this is a very specific scenario for companies which are engaged in oil exploration and production. Now, before we move on to what the clarification is, let us try to understand what does the term cost petroleum means. Now, cost petroleum is a very unique kind of an agreement which is entered between an oil exploration company and the government of India. As you know that the companies which are engaged in oil exploration and production, they enter into an agreement with the government of India. Now, what is that agreement? The agreement is that the companies will engage in exploration of the oil and production of the oil, and in lieu of that exploration of oil, the oil exploration company will have to pay certain royalties and a share of profit to the government of India. Now, the first question which comes to our mind is, now what kind of contract is this? Is this a partnership contract? The answer is no. This is not a partnership contract between the government of India and the oil exploration company. Then what this contract is? This contract is like a licensor and a leaser contract. What does that mean? So oil exploration company has basically undertaken the license to explore the oil, and in lieu of that exploration or the license which they have undertaken, they are required to pay certain royalty to the government of India, and in addition to the royalty they may also be required to pay certain share of profit. Now what the clarification is regarding cost petroleum. So basically what happens in the contract which is entered by the oil exploration company and the government of India, there is a provision which says that the expenses which is incurred by the company, the oil exploration company, in regard to exploration, development, production of the oil, that can be reduced from the revenue. What does it mean? Exploration of oil is not a one day affair. It requires a lot of effort, money, and resources from the oil exploration company. Okay, so the provision in the contract says that initially the oil exploration company can recover those costs from the revenue that they might generate when they have started production of the oil or generating the revenue. The cost which they are recovering, the cost of all the manufacture and exploration which they are recovering, is regarded as a cost petroleum. Okay, now the question which comes is whether cost petroleum will be considered as a consideration because they are taking that entire revenue and not sharing anything with the government of India, and whether it will be liable for tax or not. Okay, so now let us read through the clarification which has been issued. The first portion of the clarification basically talks about whatever we have discussed until now. So it explains what the term petroleum means. As per the production sharing contract between the government and the oil exploration and production contractors, in case of commercial discovery of petroleum, what does the term commercial discovery of petroleum means? Commercial discovery of petroleum means that oil exploration company does not necessarily know that wherever they have started digging the oil, digging for the oil, whether they will actually get an oil over there or not. So this contract, the production sharing contract, basically says that the oil exploration company has got the right to start exploring certain oil in a particular location, and only when they have identified certain oil which has some commercial value, that is regarded as commercial discovery of petroleum. That means they have discovered a petroleum which is commercial, that means they can be sold in the market. The contractors are entitled to recover from the sale proceeds all expenses incurred in exploration, development, production, and payment of royalty. Okay, so whatever expenses they have incurred in exploration, development, production, and payment of royalty, they can recover when they have identified a commercial discovery. Okay, now all these expenses they have which they are recovering is regarded as cost petroleum. Portion of the value of petroleum which the contractor is entitled to take in a year for recovery of these contract costs is called as cost petroleum. Now, The second para basically explains the relationship between the Government of India and the oil exploration company. The relationship of the oil exploration and the production contractors with the government is not that of a partners but that of a licensor and the lessor and license leasee in terms of the Petroleum Natural Gas Rules 1959. Having regard the right to explore, exploit and sell petroleum in lieu of royalty and a share in profit, petroleum contractors carry out the exploration and production of petroleum for themselves and not as a service to the government. Para 8.1 of the Model Production Sharing Contract states that, subject to the provision of the PSC, the contractor shall have exclusive right to carry out petroleum operations to recover cost and expenses as provided in this contract. The oil exploration and production contractors conduct all petroleum operation at their sole risk, cost and expense. Hence, cost petroleum is not a consideration for service to the Government of India and thus not taxable per se. So it is clarified that it is not taxable. However, cost petroleum may be an indication of the value of mining or exploration services provided by operating member to the joint venture in a situation where the operating member is found to be supplying services to the oil exploration and production joint venture. Now, this third para basically talks about something different. It says that if there is any separate incidental services which are provided by any operating member to the oil exploration company, that's a different thing. That is certainly not exempt. But the any revenue which is recovered as part of cost petroleum, that is not taxable under GST law. So this was a clarification which was issued by the Government of India. This is very specific to a particular industry. However, since this is a very important and a unique kind of a clarification, it may be tested in your examination. Friends, moving on to the next clarification. Now the clarification is with regard to the taxability of PSLC, whether or not PSLC is taxable under GST law. The question which comes is, what does the term PSLC means? The term PSLC basically denotes priority sector lending certificates. Now, what is priority sector lending certificate? We will talk about that. But the clarification says that whether or not priority sector lending certificates are taxable under GST law. And why this question comes? Because as per the Reserve Bank of India FAQ, the priority sector lending certificates are classified as goods. Okay, now before moving on to that clarification, let us talk a little bit about what does the term priority sector lending certificate means. So friends, priority sector lending certificate is nothing but a tool which is used by the Reserve Bank of India to promote competitive advantage among banks in order to meet their priority sector lending obligations. So basically the Government of India and the Reserve Bank of India want to promote certain specific sectors. And in order to do that, they classify certain specific sectors as priority sectors. And what does that classification means? The classification means that now the banks are obliged to provide additional loans to those specific sectors. Or the Reserve Bank of India mandates that there has to be certain specific proportion of their total loans that needs to be given to a priority sectors. And the banks or who has exceeded that threshold limit will earn certain social credits in the form of PSLC. And those banks which have not met those obligations will have to purchase those social credits from other banks who has already done it. That means what? Suppose there are two banks, Bank A and Bank B. Bank A has granted additional loans to certain priority sectors, as a result of which they have earned certain PSLC. That means priority sector lending certificate. However, Bank B has not been able to meet those obligations, As a result of which, what will happen? Bank B will reach out to Bank A and say that, can you sell me your priority sector lending certificate? Now, the question which comes is, when priority sector lending certificates are sold by Bank A to Bank B, whether those will be chargeable to GST or not. And why this question comes? Because the Reserve Bank of India FAQ on PSLC, it states that PSLC may be construed to be in the nature of goods. Friends, we have already discussed that securities are not taxable under GST law, but Reserve Bank of India or RBI's FAQ itself says that PSLC are not securities, they are classified as goods. PSLC are not securities. PSLCs are similar, akin means similar, to freely tradable duty scrips, renewable energy certificates, REP license, or replacement license, which attracts VAT. Okay, so you can construe PSLC very similar to the renewable energy certificates or REP license, which used to be classified as goods for the purpose of VAT. Okay, now in GST there is no specific exemption which has been given for the trading of PSLC, and thus PSLC will be taxable as goods at a standard rate of 18% under the residuary serial number 453 of Schedule 3. And any GST payable on the certificates would be available as ITC to the bank buying these certificates. So the bank who has purchased the certificates, whatever GST they will pay, they can claim input tax credit of that amount. Okay, so this is a very good clarification, and which is very different from the usual practice. So it is very important from your examination point of view as well. Moving on to the last amendment, which deals with the taxability of cash calls made by joint ventures. So this is another clarification which was issued by the government, which clarifies that whether cash calls made by joint ventures will be taxable under GST law or not. Now, what does the term cash call means? So joint ventures are usually formed by two or more corporations or two or more parties, right? Now, that joint venture may require certain funds, and as a result of which, what they can do, they can reach out to either of the parties who have been a party for the formation of joint venture for that fund. Now the question which comes is, the fund which is provided by the joint venture partner, whether that will be taxable under GST law or not. Now there has been a specific clarification which was issued for the cash calls made by the joint venture under service tax law. Let us try to understand that first. So CBEC White Circular number 179/5/2014 issued from folio number certain dated 24 to September 2014 has clarified that if cash calls are merely transaction in money, then they are excluded from the definition of service provided in section 65B subsection 44 of the Finance Act 1994. Now, whether a cash call is merely a transaction in money or not would depend on the terms of the agreement. Now, what does the transaction in money means? Transaction in money means if a joint venture is requiring certain cash, they have reached out to the joint venture partner or the joint venture promoter and has got certain money. That it's a plain vanilla situation where they were looking for a fund, the joint venture was looking for a fund, and one of the party has infused certain additional fund. That will be called as a transaction in money. So if it's a plain vanilla situation, if it's a normal infusion of fund, then it's fine. It will not be covered under the service tax law. So that was the stance under service tax law. Now there was no such clarification which was made under GST law, and this clarification was in line of the service tax law provisions. Now under GST law also the position has not changed. The government has clarified that combined reading of the scope of supply, definition of business, and para 7 of Schedule 2, which deals with the supply of goods by an unincorporated association to its member, implies that supply of services by an unincorporated association or body of person to a member thereof for a cash deferred payment, or other valuable consideration shall be treated as supply of services. This we have discussed, right? So if an unincorporated association has provided certain services to other member for any cash, that will be regarded as a supply. Therefore, the law with regard to the levy of GST on service supplied by a member of an unincorporated joint venture to the joint venture or to the other members of the joint venture or by joint venture to its member essentially remains the same as it was under the service tax law. Thus, it has been clarified that Board Circular number 179/2014, the one which we have just discussed, dated 24 September 2014, in the context of service tax is applicable for the purpose of levy of GST also. So for the purpose of levy of GST also, the stance remains the same. So if it's purely a transaction in money, then it will not be taxable under GST law. But if it's not a transaction in money, if it's any service which has been provided to the member and in lieu of that service a certain consideration has been received, in that case GST will be liable. Let us try to understand what will be classified as transaction in money and what will not, with the help of certain examples. Let us take two illustrations, one which will talk about transaction in money and the other which will talk about other kinds of situation. Let us talk about illustration 1. Suppose there are 4 members in the joint venture including the operating member, and each one contributes rupees 100 as part of their share. So there are 4 members who have created a joint venture, each of them has contributed 100 rupees. A total amount of 400 is collected. The operating member purchases machinery for rupees 400 for the joint venture to be used in oil production. So the operating member has purchased certain machinery for rupees 400 for the joint venture to be used in oil production. Now, obviously, the joint venture got 400 rupees and the operating member has used that 400 rupees to purchase the machinery. So this will not be subject matter of GST for the reason that operating member is not carrying out an activity for another for consideration. So that operating member has purchased the machinery for the use of the to be used by the joint venture itself, and therefore they are not carrying out any activity for someone else. The money paid for purchase of machinery is merely in the nature of capital contribution and is therefore a transaction in money. Clear? So these kind of transaction in money kind of a situation are not covered under GST law. Now let us talk about another situation. Let us take the same illustration. There are 4 members in the joint venture including the operating member, and each one contributes 100 as part of the share. That means total 400 rupees is collected. The operating member thereafter uses its own machine and performs exploration and production activities on behalf of the joint venture. So each one of them has contributed 100 rupees, but that 400 rupees has not been used. Instead, operating member has used his own machinery for carrying out certain production activities on behalf of joint venture. This means what? He is using his own machinery for the purpose of joint venture. That means what? He is providing certain services. In this, the operating member uses his own machinery and therefore providing services within the scope of supply of GST. This is because the operating member is recovering the cost appropriated towards machinery and services from the other joint venture member in the participating interest ratio. And this kind of situations are taxable under GST law. Friends, to be very clear, this cash calls kind of a situation can be understood in the common parlance also. So if it's a mere infusion of funds, then in that case it's not taxable. But if any services are being provided by any member to the joint venture, in that case it will be taxable under the GST law. So these are some of the clarification or amendments which are issued by the government which are applicable for your November 2018 examination.